Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Right now, as you listen to this, over $1 trillion of private investment capital is just aggressively hunting for a place to park.
Yeah, that's right. Over $1 trillion.
And the strange thing is, well, a massive chunk of that money isn't looking at Silicon Valley startups or, massive multinational conglomerates.
No, not at all.
It is looking at the local landscaping company down your street. It's looking at the plumbing supply warehouse on the edge of town and, the 30-year-old bakery on the corner.
It's really a massive pivot in how capital flows. I mean, we are seeing headlines about global mega deals, right?
Like SpaceX acquiring XAI for $250 billion.
Exactly. But those astronomical figures often blind us to the really aggressive, sophisticated financial machinery operating right at the neighborhood level.
And that machinery is exactly what we are unpacking in this deep dive.
Right.
If you own a small business, or if you're thinking about buying one, or if you're just wildly curious about what the economic engine of your own neighborhood is actually worth, we've got you covered.
We are filtering through a massive stack of 2026 financial outlooks today.
Yeah, we've pulled reports from KPMG, KeyBank, Axial, PwC, Bain, and ACG.
The heavy hitters.
Right. And our mission is to extract the ground truth of what is actually happening in the lower middle market and Main Street business sales.
No Wall Street jargon today.
None. Just the mechanics of how these deals work today.
So to set the baseline, when we talk about M&A, which is mergers and acquisitions, we are really just describing the ecosystem of businesses buying and selling other businesses.
Simple enough.
Right. And the 2026 global M&A market is this massive $4 trillion machine. But the way that $4 trillion is behaving right now is what economists refer to as a K-shaped market.
Okay, let me test that logic, because I hear K-shaped recovery thrown around on financial networks constantly.
Oh, yeah. It's the buzzword.
It is. The visual is the letter K, right? One line goes up, one line goes down. But how does a letter describe a $4 trillion market?
That's a great question.
Are you saying half the businesses are selling for record highs and half are going bankrupt?
Well, it is less about the fate of the individual businesses, and more about the structure of the deals themselves.
Okay.
The upward pointing branch of the K represents total deal value. That number is climbing.
So the dollar amount is going up.
Yes. But it's driven entirely by a handful of mega corporations pursuing massive transformational acquisitions, primarily in AI infrastructure, data centers, and energy.
Oh, right.
They are spending hundreds of billions in single transactions, which pulls the total dollar value of the market upward.
But that leaves the downward pointing branch.
Right.
Exactly what does that represent?
That downward branch is deal volume, basically the actual number of transactions closing.
I see.
Global deal counts are dropping by roughly 10 to 15% this year. So fewer deals are happening overall, but the ones happening at the absolute top of the market are historically massive.
That makes sense.
Yeah, meanwhile, down on Main Street, in the middle market, transaction volume has slowed significantly. Buyers are enforcing this very disciplined, fundamentals-driven reality check.
Which means we need to really understand the weather system driving these buyers. I've seen multiple reports refer to 2026 as a reset to release phase.
Yeah, that phrase pops up everywhere. The reset is really the psychological and financial hangover from the last 5 years.
Right.
We experienced that wild bull market of 2021 where interest rates were basically zero, capital was virtually free, and businesses were trading hands at frantic speeds.
People are buying anything.
Exactly. Then came the shock. Soaring inflation, aggressive interest rate hikes, and just severe geopolitical instability.
The cost of borrowing money essentially quadrupled in what felt like overnight.
Right. And that fundamentally broke the math of M&A for a couple of years. Buyers and sellers were basically trapped in a staring contest.
Because sellers still wanted those 2021 premium prices.
Exactly. And buyers flat out couldn't afford to pay them because their debt was just too expensive.
So what's the release part?
Well, now, in 2026, we've hit the release. Both sides have finally accepted this new normal of higher capital costs.
The staring contest is over.
Yeah. The pent-up demand is releasing, but buyers are proceeding with extreme caution.
Let's pull that thread because the numbers here present a fascinating contradiction.
They really do.
You said deal volume is down 10 to 15%, but the Bain and ACG reports highlight that private equity firms have over $1 trillion in dry powder.
Yes, $1 trillion.
For anyone unfamiliar, dry powder is just cash sitting on the sidelines. It's money that investors, pension funds, university endowments, wealthy individuals have handed over to these private equity managers.
Right, legally committing it to be invested.
Yeah.
It is capital that literally costs these firms money if they don't deploy it, because they charge management fees based on active investments and they need to generate returns.
Right.
Over $1 trillion is a historic, almost suffocating amount of capital just waiting to be spent.
So if they have $1 trillion burning a hole in their pockets and they are highly incentivized to spend it, why on earth is the volume of closed deals dropping?
It's a paradox, right?
Are they just not finding anything to buy?
Well, the capital is abundant, but the cost of the debt they use to leverage those purchases is high. But more importantly, the buyer's perception of risk has fundamentally shifted.
How so?
The 2021 market was defined by the fear of missing out. If a buyer found a moderately good company, they bought it instantly, totally ignoring flaws.
Just under the assumption that a booming economy would allow them to grow their way out of any operational problems.
Exact.
Growth at all costs, right? Just acquire the revenue and figure out the margins later.
But that era is definitively over. Today, the mantra is resilience and cash flow.
The fundamentals.
Right. The Axial Lower Middle Market Survey quantifies this shift perfectly. Finding quality deals is still a struggle, but buyer anxiety over operational risk is just spiked.
Give me the numbers on that.
In 2025, 12.5% of investors cited operational risk as a deal killer. In 2026, that number jumped to 20.7%.
Wow, that's a huge jump. I want to make sure I'm visualizing this operational risk correctly.
Go for it.
Think about the real estate market a few years ago. Buyers were waiving inspections, buying houses sight unseen, throwing cash at anything with a roof.
Oh yeah, it was wild.
But the 2026 M&A market feels like a buyer showing up to a modest 3-bedroom open house with a microscope, a black light, and a structural engineer.
Yes.
The money is sitting right there in their briefcase, but they refuse to hand it over until they check the foundation with a laser level. Is that what's happening to business sales?
The structural engineer analogy is highly accurate. What's fascinating here is that the buyers aren't broke. They are just incredibly cautious.
Because of the interest rates.
Exactly. Because if you are borrowing money at 8 or 9% to buy a business instead of 3%, your margin for error is razor thin.
Right.
Buyers today need mathematical certainty that if inflation spikes again, or if a supply chain collapses, the business will still generate enough free cash to make the monthly debt payments.
Makes sense.
If a target business has a messy ledger or, relies too heavily on a single massive customer or has high employee turnover, the buyers don't try to fix it. They just walk away.
Which is a brutal reality check for the listener who owns a business and thinks about selling.
Oh, absolutely.
A charismatic pitch deck just doesn't cut it anymore. If your operations aren't bulletproof, you can't access that $1 trillion of dry powder.
You really cannot outmarket bad operations in 2026. Buyers are underwriting for worst-case scenarios, and deals routinely die during due diligence when those operational flaws are uncovered.
Okay, so assuming a business actually survives the blacklight and the structural engineer, how do they actually agree on a price tag?
That's where the math gets interesting.
I really want to completely strip the jargon out of this because figuring out what Main Street is worth seems entirely disconnected from how Wall Street values things.
It is entirely different. To do that, we have to segment the market.
Yeah.
The financial industry generally defines the lower middle market as businesses valued between $5 million and $50 million. Below that, you have Main Street, which covers businesses valued under $2 million.
So Main Street is the local machine shop, the busy diner downtown, the 5-truck residential roofing company.
Exactly.
And lower middle market is more like the regional logistics hub or a software firm with 100 employees.
Right. And the distinction matters because the two tiers use entirely different math to determine their value.
How so?
For the larger companies, buyers use EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Right.
It's an accounting metric designed to measure purely operational profitability, stripping out the financial structure.
I'm struggling to see how EBITDA helps someone buy a pizza shop.
It doesn't.
Because a pizza shop owner or a plumber doesn't run their business to maximize their taxable profit on a balance sheet. They run it to support their lifestyle and minimize their tax burden.
That is the exact reason EBITDA fails on Main Street. A small business owner might run their personal cell phone bill, their spouse's car lease, and their health insurance through the company.
Oh, sure.
They might pay themselves an inflated salary, or conversely, a tiny salary to avoid payroll taxes. The bottom line profit on their tax return is almost always a carefully engineered fiction designed for the IRS.
Right. So if the bottom line is fiction, how does a buyer figure out the reality?
They use a metric called SDE, Seller's Discretionary Earnings.
SDE.
Yes, this is the foundational metric for valuing any Main Street business.
Break down SDE for us. If I'm looking at the books of a local hardware store, how do I actually find the SDE?
You're trying to determine the true total amount of cash a new owner-operator could expect to pull out of the business in a single year.
Okay.
You start with the bottom line net profit, then you begin a process called add backs.
Add backs.
Right. You add back the owner's salary because the new owner might pay themselves differently. You add back the personal vehicle lease the business pays for. Exactly. You add back the country club membership, the personal travel categorized as research, the non-essential family members on the payroll.
Let's do the math on a hypothetical.
Okay, let's hear it.
We have a local residential plumbing company, good reputation, 3 vans. The owner's tax return shows a net profit of just $50,000 for the year.
Very common.
But we start digging. We add back the owner's $120,000 salary. We add back the $15,000 lease on the owner's personal truck.
Yep.
We add back $10,000 in personal health insurance and maybe $5,000 in meals and entertainment that were technically personal dinners.
So in that scenario, your net profit was $50,000, but your SDE, the actual cash benefit generated by the business, is $200,000.
Okay, so the SDE is $200,000. How do we turn that into a purchase price?
The market applies a multiple to that SDE. In 2026, the data shows that Main Street businesses are clearing at multiples ranging from 2.0 to 3.0 times their SDE.
So our plumbing company generating $200,000 in SDE would sell for somewhere between $400,000 and $600,000.
Right.
What determines if you get the 2.0 multiple or the 3.0 multiple?
Several factors, but size is a massive one. There is a demonstrable size premium in the market.
Meaning bigger is better.
Exactly. The larger the business, the more systemized it tends to be, which lowers the perceived risk for the buyer.
Got it.
The reports show that businesses in the $1 million to $2 million transaction range are currently commanding an average multiple of 2.8.
Wow.
But a business selling for under $500,000 might only command a 2.1 multiple.
So if that plumbing owner wants to maximize their price, they need to grow the actual SDE pool, but also demonstrate that the cash flow is highly reliable to push that multiplier up.
Precisely.
But here's where the 2026 reports throw a massive wrench into this seemingly simple math. Owners are increasingly refusing to hire accountants and M&A brokers to figure this out.
Yeah, this is a huge shift.
They are turning to AI.
It is one of the most disruptive and honestly dangerous trends we are tracking right now.
The data says owners are plugging their QuickBooks data into AI agents, answering a few prompts, and getting evaluations spit back at them in seconds.
Just instantly.
Here's where it gets really interesting. To me, this sounds exactly like using WebMD to diagnose a sharp pain in your side.
Oh, that's a great comparison.
I mean, it gives you a sense of control, it throws out some data points, but an algorithm hasn't palpated your abdomen.
Right.
In the business sense, an algorithm hasn't walked through the warehouse and seen the leaky roof. It doesn't know that the owner's nephew is the only person who actually understands how the inventory software works.
The WebMD analogy captures the peril perfectly, because an algorithm operates on the assumption of clean data and average conditions.
Which is never the case.
Exactly. The reality of Main Street is messy and highly qualitative. The Axial data highlights the consequence of this.
What does the data say?
The number 2 reason deals are failing in 2026, cited by 48.1% of advisors, is unrealistic valuation expectations.
Wait, really? Almost half of all failed deals die because the seller thinks the business is worth more than the buyer's willing to pay?
Yes, and AI is actively widening that gap.
How so?
Well, an owner feeds their revenue into an AI tool, which applies an industry average 2.8 multiple and tells them their business is worth $1.5 million.
Right.
The owner anchors to that number. But when the human buyer shows up and conducts due diligence, they find the leaky warehouse roof, the undocumented inventory system, and the heavy reliance on the nephew.
I see.
So the buyer's risk assessment drops the multiple to 2.0, valuing the business at $1 million.
That's a $500,000 gap.
Exactly. The seller feels insulted by the quote-unquote lowball offer because the AI told them they were worth more.
And the buyer refuses to overpay for operational messiness.
Right. The deal collapses. AI might give a business owner a mathematical multiple, but it misses the qualitative quality squeeze.
Meaning, buyers want A-grade assets, and AI can't verify if your financials are actually clean.
You hit the nail on the head. It can calculate the math, but it cannot verify the underlying integrity of the asset.
So the AI can give you a baseline, but it can't negotiate for the leaky roof.
Exactly.
Which brings us to the actual people writing these checks.
The buyers.
Right. Historically, if you owned that local plumbing company and you were ready to retire, your exit plan was pretty simple.
Sure was.
You either sold it to your most ambitious employee or you sold it to the slightly larger plumbing competitor one town over. The buyer was hyperlocal.
But the 2026 data completely shatters that assumption.
It really does.
It is a fundamental rewiring of small business ownership. Currently, 68% of closed transactions in the lower middle market involve buyers located more than 100 miles away from the target company.
Let me just process that. Over 2/3 of the time, the person buying a local community-based business lives in a different city or a completely different state.
That is exactly what the data indicates.
So what does this all mean? If we can work from anywhere, we can apparently buy a business from anywhere.
Yeah, geography is mattering less and less.
But how does that even work practically? If a syndicate of investors based in Chicago buys a 30-person HVAC company operating in Dallas, Texas, who goes out and quotes the ductwork?
Right.
Who deals with the angry customer when the AC fails in August? What is driving someone hundreds of miles away to buy a local blue-collar business?
It is the intersection of two massive macroeconomic forces.
Okay, let's break them down.
The first is supply side. It's the silver tsunami.
The baby boomers aging out of the workforce.
Millions of them. Baby boomers own a disproportionate share of small businesses in the U.S., and they are hitting retirement age.
Right.
Historically, they might have passed the business down to their children. But today, the children of a successful local manufacturer or plumber are often working in software, finance, or medicine in major coastal cities.
They don't want to come back to Ohio or Texas to run the family machine shop.
Exactly.
Yeah.
Consequently, an unprecedented volume of profitable, established businesses are hitting the market simultaneously.
And what's the second force? The demand side.
The demand side is fueled by a massive shift in how capital is pooled, driven by a movement called ETA.
ETA.
Right, entrepreneurship through acquisition.
Entrepreneurship through acquisition. So instead of starting a company in a garage, you just raise money and buy a garage that's already profitable.
Precisely the concept. We are seeing a surge in investor pooling, so searcher syndicates, independent sponsors, and small private investor groups.
How does that look in practice?
Often, a young, highly educated professional, perhaps an MBA graduate, will raise a small pool of capital from investors. This initial capital isn't to buy a business. It's just to fund the search for a business for 18 to 24 months.
Wait, so they are getting paid just to scour the country looking for a retiring boomer?
Yes. Once they find a suitable business, say that HVAC company in Dallas, they go back to their investors, raise the actual acquisition capital, buy the business, and the searcher steps in as the new CEO.
Wow.
They are geographically agnostic.
Yeah.
They don't care if the business is in Texas, Ohio, or Maine, as long as the cash flows are strong.
But I'm still stuck on the operational reality here.
Okay.
A 28-year-old MBA from Chicago doesn't know how to braze a copper pipe or diagnose a blown compressor. If they buy that HVAC business, how does it not immediately collapse?
Because they aren't buying the business to fix air conditioners. They are buying the business to manage a system.
Oh, I see.
They want to buy a highly systemized, self-sustaining asset.
Oh.
They rely on the existing middle management, the lead technicians, the dispatchers, the sales team, to handle the actual technical work.
So what does the new CEO actually do?
The new CEO's job is capital allocation, upgrading the software, optimizing the marketing, and perhaps acquiring other small HVAC companies in the area to build a regional powerhouse.
Which perfectly explains why the phrase owner dependence shows up in every single report as a massive deal killer.
It is the absolute antithesis of what a remote buyer wants.
Let's define owner dependence, because I think a lot of small business owners view their indispensability as a badge of honor.
They really do.
They say things like, the business would fall apart without me. They work 80 hours a week. They hold every major client relationship in their head.
Right.
They personally sign every check and do all the estimating.
And to a remote buyer, that business is virtually worthless.
Worthless.
Pretty much.
Yeah.
Because if a search fund from Chicago buys an owner-dependent business in Dallas, the minute that founder signs the closing documents and moves to Florida, the value of the business evaporates.
Because the institutional knowledge, the client trust, the operational engine, it all leaves with the founder. So ironically, to sell a business for top dollar, the owner has to completely engineer themselves out of a job. They have to make themselves obsolete.
The business must be a turnkey machine. If it requires the founder's daily intervention, it is a job, not an asset. And pooled capital groups are looking to buy assets, not jobs.
This leads us directly into the concept of the quality squeeze.
Yes, the quality squeeze.
You mentioned earlier that there is $1 trillion in dry powder, but it's not being sprayed indiscriminately. The capital is aggressively chasing a very limited pool of what you called A-grade assets.
Right, abundant capital chasing a very limited tool.
So what separates an A-grade asset from a B-grade or C-grade business right now?
The defining characteristic, the holy grail of the 2026 M&A market, is recurring revenue.
Recurring revenue.
Yes. According to Capstone Partners' survey of investment bankers, 66% of buyers cite recurring revenue as the single most critical factor they evaluate in a target company.
How does a traditional Main Street business build recurring revenue? I mean, a software company charges a monthly subscription, sure. But how does a landscaping company or a plumber do it?
By fundamentally shifting their business model away from break-fix, episodic work.
Give me an example.
Okay. A C-grade plumbing company waits for a pipe to burst, hopes the homeowner finds them on Google, fixes the pipe, and never sees the customer again.
Right.
The revenue starts at zero every single month. But an A-grade plumbing company has 1,500 local homeowners signed up for a $25 a month annual maintenance plan.
Oh, wow. So before the month even begins, they know exactly how much cash is hitting the bank account.
Defensible, predictable cash flows. If a business can demonstrate contractual, recurring revenue, their valuation multiple expands immediately.
What else makes an A-grade asset?
The other pillars are technology enablement and specialized delivery. Are they using modern enterprise resource planning software to track inventory, route trucks, and manage customer data?
Do they have a moat, basically?
Yeah, exactly. Do they offer a specialized service that creates a moat against local competition?
Okay, so the formula is clear. Systemize your operations, eliminate owner dependence, build recurring revenue, and implement modern tech.
Simple to say, hard to do.
Right. But here's the disconnect that just blows my mind. The buyers are demanding A-grade assets. Yet the data shows that the vast majority of business owners enter the market having completed absolutely zero formal exit planning.
It's true. The vast majority.
I mean, if you were selling your car, you'd at least take it to the car wash and clean the fast food wrappers out of the back seat.
You'd hope so.
But business owners are trying to sell multi-million-dollar companies with zero exit planning. Why the disconnect?
The structural reason is a lack of education regarding the timeline of M&A. It takes years to properly prepare a business for sale, not months.
Right.
But the psychological reason is profound, and advisors refer to it as seller fatigue.
The psychological toll of the last few years.
Consider the timeline. A boomer business owner survived the chaotic shutdowns of the pandemic. They immediately had to navigate historic, crippling supply chain disruptions.
Then came severe labor shortages and massive wage inflation.
Then the cost of their credit lines tripled as interest rates spiked.
They are just exhausted.
Completely exhausted.
Yeah.
Many have reached a psychological breaking point where they just want out immediately.
They just throw their hands up.
Yeah. They decide on a Tuesday that they are done and they want the business sold by Friday.
Wow.
They throw the business onto the market without formalizing their accounting or upgrading their systems, hoping that the sheer profitability of the business will overcome the messy presentation.
They are hoping that someone buys the Honda Civic for top dollar, even though it's filled with fast food wrappers, just because the engine runs well?
In the 2021 market, someone might have. But in the 2026 market, with the cost of capital so high, buyers are ruthless.
Right.
Furthermore, buyers are specifically looking for targets where they can deploy artificial intelligence to aggressively scale margins.
Meaning they want to improve productivity, not just replace headcount.
Yes. They want to buy a business, inject AI into the back office operations to automate scheduling, billing, and customer service, and double the output without adding proportional headcount.
So if an owner brings a highly labor-intensive analog business to market with messy books and zero-tech infrastructure, the buyer isn't going to see it as a charming fixer-upper.
No, they're going to see it as a massive operational liability.
A headache.
They will heavily discount the valuation or just pass on the deal entirely. The quality squeeze means B-grade businesses are sitting on the market unsold for months or years.
Let's pivot to the macro environment, because this is where the story gets incredibly complex.
It really does.
Let's assume a listener has done everything right. They spent 3 years cleaning up their books. They built a robust recurring revenue model.
They did their homework.
Right. They replaced themselves with strong middle management. They have a pristine A-grade asset ready for market. Even then, external forces, the macro clouds, can blow the deal up.
Yep.
The surveys list geopolitical and macroeconomic uncertainty as the #1 risk deal makers are facing.
You can control your own ledger, but you cannot control the weather.
Right.
And the prevailing weather system in the U.S. right now is driven by the legislative impacts of H.R. 1, the One Big Beautiful Bill Act.
I want to frame this very carefully because we are looking at this strictly through an analytical financial lens.
Of course.
Look, buyers don't care about politics. They care about math.
Right. The spreadsheet doesn't have a political party.
Exactly. So impartially speaking, what does H.R. 1 actually do, and how does a piece of federal legislation directly alter the asking price of a local business?
Impartially, the legislation fundamentally alters 3 pillars of the macroeconomy: tax policy, federal spending allocations, and immigration enforcement.
Okay.
For Main Street M&A, the provisions regarding immigration and taxation are creating immediate, measurable ripple effects.
Let's start with immigration.
Let's look at the labor market first.
Yeah.
The bill mandates significantly enhanced immigration enforcement and verification protocols.
Which means the available labor pool for certain industries shrinks.
Precisely. The immediate economic consequence is acute labor scarcity in specific sectors, most notably construction, agriculture, light manufacturing, and transportation.
And when the supply of labor drops, but the demand for the work remains constant, wages must rise.
Supply and demand.
Let's walk through the math on that. If a buyer is looking at acquiring a local commercial roofing company, and because of these new enforcement protocols, that roofing company suddenly has to increase their hourly wages by 15 or 20% just to retain a crew.
Yep.
The gross revenue of the business might be the same, but the cost of goods sold just spiked. Does the buyer just lower their offer?
Well, if we connect this to the bigger picture, macro policy translates directly into M&A math.
How so?
The profit margin shrinks, which means the SDE shrinks. And as we established earlier, if the SDE drops, the multiple applied to it yields a much lower purchase price. Buyers are aggressively modeling these new labor costs into their forward-looking projections. If they believe a business is highly exposed to this specific wage pressure, they simply lower their offer.
It's an instant devaluation based purely on external policy.
Exactly.
Are buyers just accepting these lower margins, or are they taking their capital elsewhere?
They are rotating their capital. We are seeing a distinct sector rotation away from labor-intensive, supply chain-dependent industries.
And moving toward what?
Toward what they label recession-resilient, non-cyclical industries.
What qualifies as non-cyclical right now?
Business-to-business services. Think outsourced IT management, specialized accounting, or corporate compliance consulting. Healthcare services are also seeing massive premiums. These industries are perceived as insulated from tariff battles and physical labor shortages.
So if your business relies heavily on imported physical goods that might face new tariffs or cheap physical labor that is now scarce, your valuation multiple is likely shrinking right now.
Regardless of how clean your books are, yes.
And what about the tax component of the bill? You mentioned changes to tax policy impacting valuations as well.
This revolves primarily around changes to the QBI.
The qualified business income deduction.
Yes, under IRS Code Section 199A.
Break down how the QBI works in plain English.
Historically, this deduction allowed eligible self-employed individuals and small business owners to deduct up to 20% of their qualified business income straight off their taxes.
That's a lot.
It was a massive benefit that significantly increased the net take-home cash for the owner of a pass-through entity, like an LLC or an S-Corp.
So if you make $100,000 in profit, you could potentially shield $20,000 of it from income taxes.
Broadly speaking, yes. The new legislation modifies the thresholds and applicability of this deduction.
How does that affect M&A?
From an M&A perspective, any policy that increases the tax burden on the business reduces the free cash flow available to a new owner.
Because buyers calculate their return on investment based on post-tax cash flow.
Right. When taxes go up, the net yield goes down, and buyers reduce their upfront purchase price to compensate for the lower yield.
It perfectly illustrates how interconnected the system is. A bill gets signed in Washington, the labor pool tightens, wages increase, the tax deduction shrinks, and consequently, a search fund in Chicago drops their offer on a roofing company in Texas by $300,000.
That is the uncompromising math of the market.
Okay, let's look at the human element of this again. The market is incredibly tough. Buyers are wielding microscopes, debt is expensive, labor costs are rising.
It's a tough environment to sell in.
A business owner is suffering from severe seller fatigue and desperately wants liquidity, but they look at the offers coming in and they refuse to accept a discounted price for a business they spent 30 years building.
Right.
They are basically trapped between selling at the bottom of the market and dying at their desk. Is there a middle path?
There is, and it represents one of the most significant structural innovations in the 2026 market. Yes. It is the widespread adoption of continuation vehicles, or CVs, in the lower middle market.
Continuation vehicles. That sounds highly technical. What exactly is a CV?
Historically, CVs were complex financial instruments used exclusively by massive private equity funds to move assets around without actually selling them to the public market.
Okay.
But today, the core concept is trickling down to Main Street. Essentially, a continuation vehicle allows an owner or sponsor to move the business into a new ownership structure, take some cash off the table, and bring in fresh capital for another 5 to 7 year run of growth.
While staying in charge.
Exactly.
Let me test an analogy here. It sounds like a band signing to a new record label to get a cash advance, but keeping the exact same lead singer and tour schedule.
That's a perfect analogy.
They just have a powerful new financial backer fueling the marketing for their next album, and the label takes a cut of the future profits.
The mechanics of that analogy are incredibly sound. The operational structure remains intact, but the capitalization table who owns the financial upside is restructured.
Why is this becoming so popular for small to mid-sized businesses? Why not just hold out for a 100% sale?
Because it solves two massive problems simultaneously.
What's the first one?
It solves the seller's need for partial liquidity without forcing them to accept a low valuation for the entire company.
And the second?
But equally important, it solves a massive crisis on the buyer side, specifically for private equity.
What is the crisis? You said they have $1 trillion to spend.
They do, but they also have what the industry calls an exit overhang.
Exit overhang. Explain that.
Private equity firms raise money for funds that have a defined lifespan, usually 10 years. They buy a company, hold it for 3 to 5 years, improve it, and sell it for a profit to return cash to their investors.
Right.
But because the 2026 market is so tough, they can't sell their existing portfolio companies for top dollar. Their hold periods have stretched to nearly 6 or 7 years.
So they are stuck holding these businesses because they refuse to sell at a discount, but their investors are banging on the door demanding their returns.
Exactly. The CV is the pressure release valve.
How does it work for the PE firm?
The private equity sponsor creates a new fund, the continuation vehicle. They move their best performing, most resilient companies into this new vehicle. They bring in new investors to fund the CV.
Oh, I see.
They use that new cash to pay out their original impatient investors. The firm gets to keep managing a great asset. They reset the clock for another 5 to 7 years, and they wait for a better market to eventually sell.
And how does that translate down to a founder-owned Main Street business?
It creates what we call the second bite premium.
The second bite premium.
Yeah. Imagine our Dallas HVAC owner. They want out, but the offers are low. A private investor group approaches them with a CV structure.
Oh.
The group buys 60% of the HVAC company. The founder gets a massive multi-million-dollar check today, securing their family's financial future. But the founder retains 40% equity and stays on as CEO or chairman for another 5 years.
The founder gets the cash now, but still gets to ride the upside.
Exactly. The new investor group gets a resilient, profitable asset without having to replace the local founder.
Which eliminates the owner dependence risk we talked about earlier.
Right. The investor group uses their capital to acquire 3 other local HVAC companies, rolling them up into the founder's business.
Wow.
In 5 years, the combined business is sold to a massive national firm. The founder's remaining 40% equity might be worth more than the original 100% was. They get a second, much larger bite of the apple.
It completely reframes the psychology of selling a business. It's no longer a binary cliff jump, like either I stay and suffer or I sell everything and walk away.
No, it transforms selling a business from a binary stay or go into a flexible menu of options.
It provides structural optionality in a market that is deeply constrained by uncertainty.
Absolutely.
The depth of this shift is just staggering. So if you are listening to this and you are trying to navigate the reality of the 2026 Main Street market, the survival guide we've extracted from these reports is clear.
Very clear.
First, you must know your SDE. Discard EBITDA. Understand exactly how much discretionary cash your business generates.
Nice.
Second, you must aggressively prepare your operations. Get your financials audited. The buyers are arriving with microscopes. If your financials are a mess, the multiple collapses.
They will walk away.
Third, you must eliminate owner dependence. Prepare for buyers who live 3 states away.
Remote buyers are the new normal.
Fourth, secure your recurring revenue. It is the absolute requirement for an A-grade asset.
Defensible cash flow.
And finally, you have to monitor the macro weather system. Understand how Washington's tax and labor policies directly impact your asking price.
It is a market that punishes complacency and heavily rewards meticulous preparation.
But before we conclude this deep dive, I want to leave you with one final thought to mull over. Building on the data we've explored today,
Let's hear it.
we discussed how sellers are dangerously using AI like WebMD to generate unrealistic valuations for their businesses. We know software deals are cooling because AI is disrupting them, and we know owners are using AI to check their own valuations. But consider the inevitable evolution on the buy side.
Okay.
What happens when the massive private equity firms with $1 trillion in dry powder stop relying on human analysts to find deals? What happens when the buyers start using autonomous AI agents to actively scout, diligence, and negotiate with Main Street businesses at scale?
The deployment of autonomous agents in capital allocation.
Exactly. Imagine a near future where a search fund doesn't employ 28-year-old MBAs to look for retiring boomers. Instead, they deploy an autonomous AI agent.
Oh, wow.
This agent scrapes local credit card transaction data to determine real-time revenue. It analyzes satellite imagery of a local hardware store's parking lot to track foot traffic over a 5-year period.
That's entirely possible.
It cross-references the town's demographic shifts, local zoning changes, and federal tariff exposure. It builds a perfect, microscopic risk profile of a business before the owner even thinks about selling.
The friction of discovery and due diligence drops to near zero.
Right. And then it autonomously generates a legally binding, perfectly priced acquisition offer and emails it directly to the owner.
That's wild.
Will your local hardware store's next acquisition offer be generated entirely by an algorithm that scraped local credit card data and satellite foot traffic? It's coming faster than we think.
A sobering but highly probable trajectory for the market.
The waters of valuation might be muddy right now, but the buyers are rapidly developing sonar. You need to be prepared for when they look your way.
Absolutely.
Keep questioning assumptions, keep exploring the mechanics beneath the headlines, and we will see you on the next deep dive.
Thanks for joining us.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.